Are prices for multifamily apartments, are they going down? Well, we're going to be talking about that, inflation, and what's going on with rent growth and rental payments right now. We are in the third quarter of 2022. Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, any kind of real estate investor, well, the Gray Report is the perfect program for you, whether you're on YouTube or listening on the podcast. We're diving into all the latest research reports, new data, articles, and original opinions and content covering the multifamily industry, real estate, and the economy. I'm joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. We got a lot of great articles from Bloomberg, RealPage, CBRE, Multifamily Dive, GlobeSt, and the National Association of Home Builders. You're going to learn a lot to help you make some really good investing decisions in this insane time that we live in. Let's get into it. All right, welcome back to the report. Matt Bosnagel, pleasure to have you on again, as you're here every single week, breaking it down, bringing us all of the latest research, what's going on in the multifamily industry. Really, it's allowed us to be a leader of really kind of market intelligence in the multifamily space. There's really no one else kind of out there that's doing what we're doing, really what you're doing, Matt. But we're coming off holiday weekend. It's 4th of July. I've got some blisters from burns from fireworks. I don't know how's
you made it out in one piece though.
Oh yeah.
That's good.
No like limbs or appendages are gone. All relatively safe.
Yeah, I had a pretty good 4th of July. It wasn't there's a sweet spot between how dangerous the fireworks are and how fun they are. You can go over it, but you got to
go right up to the edge.
Oh yeah,
right up to the edge, and depending on who the audience is and who's around, you can maybe go a little bit past it. But.
I said this. Wouldn't it be fun if there was a fireworks show where the angle tilted and it slowly started? It would get pretty fun. Then it would get very dangerous.
Some of the best fireworks experiences I've ever had is just when you're just maybe a little too close than it's safe. Matt, we are we're fortunate though, and I take it for granted. That many other states don't have access to the quality firework options that we in the Hoosier state are used to. And again, I think take for granted. A lot of people can't get the big stuff, can't get the mortars.
I think it used to be where we couldn't get any that lifted off into the air. We could get fountains.
Oh yeah,
but not.
We've been able to get all the good stuff. In most other states, you can. It's like snakes and sparklers. I'll have to dig
into the legal history and see.
Yeah, now I know there's some like counties in Indiana where it's like it's a law, like fireworks are legal. Like it's right. It's I think Hamilton County. It's like codified. It's like no,
that's a super majority to get away.
It's like no, we can have fireworks here. That's why you drive in Indiana. There's like fireworks signs everywhere. It's neighboring states. And we were joking when we were up in Michigan at Club Meridian in the last recent acquisitions of Gray Capital. You got people coming over from Michigan buying fireworks, people from Indiana going up to Michigan to buy legal marijuana.
Yeah.
And it's the same thing out on out west. You've got people from Washington State like traveling into neighboring where like Idaho to get large capacity AR-15 magazines.
Yeah.
People going the other direction, go and get the legal weed in Washington.
Large capacity, whatever the equivalent is.
Yeah. All right, well, Matt, let's get into multifamily. Inflation. We've talked about inflation before on the report a handful of times, but man, it's not letting up. And what we found to be interesting is that over the past year or so, we've been tracking inflation very closely relative to the multifamily market, relative to the rental market in general. But it wasn't necessarily in the mainstream, the lexicon of the conversation of what was going on.
Yeah, our main. This is a multifamily podcast, and we're looking to see how inflation is going to impact the multifamily industry. And now we're starting to see, and again, we've talked about this before. We're getting to see more and more people talking about how the multifamily industry is influencing inflation, and that's kind of what this article is really all about.
Well, and especially like last year. The story in housing was single family home prices and rents were rising, but it was a secondary story. And a lot of times, like, again, financial media, they only have so much time they want to spend on housing. They want to stick to, the stock market because that's the stuff that they can sell. And, that's where the sponsorships are coming from. That's where a lot of the money is. So it'd be like, hey, quick housing report. Housing building permits are up or down. But then it was, single family home prices are going, gangbusters. And what we were talking about is, rents are growing, quite a bit. But that wasn't hitting the headlines. But now, as home prices are declining, we're still seeing rents, increase, month after month, and that's becoming the bigger story because it's starting to hit everyone's pocketbooks because everything's getting more expensive. Gasoline to food to energy to housing. And housing, in fact, was lagging a little bit. I mean, it was outpacing inflation, but there were a lot of other components that were really beating it out. But now the crosshairs seem to be on rent. But what does that mean? And this is an interesting article out of Bloomberg.
So I just picked this out. Actually, I read over a few articles on inflation because that's what seemed to be one of the most prominent parts of the economic news in the past week is really kind of an uptick in discussions of inflation, whether it is the Dow recalibrating their predictions of recession. It all kind of ties in a little bit to inflation and the actions of the Federal Reserve and reactions of the Federal Reserve, really. The CPI numbers for the month of June are due in about a week, but I don't think that people are holding off on their discussions because they're scared of getting their inflation predictions wrong.
Well, and jobs numbers coming out at the end of this week as well, 2 days.
Yeah, I think that all on, it seems like the predictions are for more inflation. I would be very curious to see what the jobs numbers are, specifically because we've heard all these rumblings about people, in the tech industry cutting back on their hires. Amazon's not hiring as much, or at least they're not planning to. And that's some things that are mentioned in these and other reports today, is the fact that we could be heading toward recession. It's not just inflation.
We could be in one.
And exactly, yeah. There's like a recession committee. There's some, and sometimes they'll, it's up in the air about what the exact rules of an official recession is.
Is it not 2 consecutive quarters of negative GDP growth?
No. There's like special sauce that's what it takes the committee. Yeah. That's why we can't do it ourselves.
We've talked about it, and I've heard some others recently now talk about it. I don't know if they listened to a couple episodes of the Great Report, but being in like this technical recession of like we have the technical 2 negative quarters of GDP growth, but the economy doesn't feel like a recession. Yeah. Even though that people, I think, unlike last year where everyone's like, oh man, the economy's great. This year it's like, well, yeah, in some ways the economy it's too good and it looks great in terms of unemployment and you've got wage growth, but then it's like, well, the low unemployment and the high wage growth is actually leading to inflation and everyone's purchasing power just is getting eroded. And
it's a strange inverse a little bit of like a weird mirror image of the jobless recovery now. I think still a lot's going to hinge on what these jobs numbers are going to be and any kind of trends from there. But like, well,
more jobs is a bad thing.
Yeah. But people are like, well, is this a job full recession? If we're the jobless recovery, it's
because that's what they're waiting on is that they don't want to say this, but they want the wages to go down. They want unemployment to go back up. And that doesn't make anybody happy, but that's kind of what they need to have happen to decrease demand so prices kind of come in check. And
it seems like there's a lot of expectations for that to happen, for employers to get more power in the negotiating table. One of the article headlines that I read was something along the lines, it was a Wall Street Journal article of like, young hires, you guys get ready. It's not going to be so easy in a couple of weeks or, a couple months or so.
It's certainly a lot different from when I think we were looking for our first jobs, after the great financial crisis, and not a great time to be entering the job market. Yeah. You just get laughed at.
But so back to this article. This article is better than kind of some of the formulaic inflation articles that we've read where, they take gas prices and they throw in, the price of peanut butter or whatever. Yeah. And that's done.
Take peanut butter out all of a sudden.
Well, if you just, you could literally like change the names and dates and write the same article 3 months in a row. And we've been reading them honestly for more than 2 years.
Do you think a lot of those are AI generated or some?
Let's hope so. Yeah. if anything, the price of these articles can come down.
Yeah.
But so, and another thing that we've been following is housing prices, as we've said before, especially rental housing. And for as much as housing prices have risen these past 2 years, the categories of housing rents and the like the owner's equivalent of housing rents have not substantially exceeded CPI or core CPI inflation rate, especially particularly if you measure by last month's numbers. So these are the latest CPI numbers for May. There's new numbers coming out, like I said, in a week, but they have rents for the May numbers. Rents are up 5.2%, and core CPI is 6%. So, and the owner's equivalent of rent is about 5.1, similar. So this 5.2 increase in rents is lower than the 6% core CPI number. Now, core CPI excludes food and energy prices. So if you put those back into the mix, inflation is at 8.6%. So the thesis of this article is that rents are going to go up so much that it's going to swing things so wildly. Well, it has not happened yet. Admittedly, I'm a little bit surprised that the rent growth measured by the census is as low as it is, but this is likely due to measuring in place rents rather than market rents. I think that most of the multifamily reports we cover have year-over-year rent growth at almost like twice the rate.
I do think there's definitely a distinction, and that there is a difference between owner's equivalent of rent and actual like rent, because it's not actual like rent at multifamily apartments or even like single family homes.
Yeah, it's not.
It's a different. It's
a way. I thought
metric.
it was a way of converting like the value of your home if it was rented or something like that. So it's in the same ballpark. I probably shouldn't have mentioned it.
Well,
but
it's kind of what we've got to use when looking at CPI. But just looking at just quickly, the Bureau of Labor Statistics defines as owner's equivalent of rent. It measures the majority of the change in the shelter cost of consumer experience. So it's not the exact same, but it's the metric that they use, and we have to compare.
It's kind of like home price, maybe utilities or something, or whatever maintenance costs could be. Whatever, everything that's bundled up in rent seems a little vague, but.
Exactly. It's relatively vague. Well, no, I mean, there are some definitions, but it's not, I would say it's just not an equivalent to actual rent growth.
Okay.
Yeah.
Like I said, it's strange a little bit that rent growth is so low as measured by the CPI. The apartment list rent growth number is 14.1%.
Yeah. So yeah.
So, comparatively, and that 14.1% is not too much different than like the Yardi matrix numbers around the same. And so, there is a big difference.
Well, because like a lot of the housing stock like hasn't like for market rent growth, that's like new leases that are being signed. But if you think about it, it's like owner equivalent of rent. Someone's owned their house for, the 50 years, they've got a low price basis on that.
So, yeah. So, kind of to return to the Bloomberg article, the author is really concerned about that connection between the rising in rents, even though we've showed how it hasn't reached the levels of overall CPI. He's very concerned and really strikingly confident about how things are going to play out. He says increasingly first-time home buyers are getting priced out of the market, and that will put upward pressure on rents. With recent consumer spending already weak, the prospect of further tightening will be too much to bear for the U.S. economy. So eventually, and he says this later, is what's going to happen is rents are going to rise. That's going to rise the inflation, because rents are the price of shelter is such a huge factor of within a slice of the pie when it comes to calculating CPI. So a little change in shelter costs is going to really skew CPI numbers. And once CPI goes up, inflation's going to go up. Then the Fed's going to try to correct it.
Yeah.
Then we're going to get a recession.
Yeah. Well, and I think that line of thinking makes sense. The only thing I would add into that, which kind of part of the leads to the inflation, is that rent growth often, precedes wage growth. And so because a lot of times people think, oh, people are making X and then they can afford X in rent. Well, a lot of times what happens is the rent gets increased. Then they go to their employer and say, my rent's gone up, I need a raise. And because, what's going to drive someone to go, people may want to go in and ask for a raise, but it's usually not until like they're forced to, because people don't want to have the awkward conversation. But it's like, I was paying $800. Now I'm paying $1,200 a month. I just can't afford it. Hey, look, I want to keep working here, but like, this is I have no other choice. I at least need to come to you and have a conversation with you. And then you extrapolate that over, so many millions of Americans who are like, hey, my rent just went up. We're in peak leasing season, right? So a lot of these leases are being traded out. Even though there was rent growth last year, all the absorption from those effective leases up to market rate that we've been talking about for the last 12, 16, 18 months, that's happening right now.
Yeah.
And people are getting the sticker shock, and then they're going around, and we just had talked about this in our asset management meeting, is, on some renewal rates, they're like, hey, wow, that's more expensive than I was paying. I'm not sure if I'm going to pay that. And so then they don't sign the renewal right away. Then they go shop around all the other apartment communities in the area. Yeah, thinking they're like, oh, they're overcharging. I'm going to get a better deal somewhere. And they realize everyone's rent has gone up.
And then they don't get the renewal rate.
And they've gone up on the market rates are much more than the renewal rate. So they're like, why, even though this is more expensive, it's a lot cheaper than moving. Moving is expensive. It's, the time, the energy to do that. You're going to be paying more rather than just staying in the place that you are, maybe paying a little bit more than you were, but still cheaper than somewhere else. So people are staying put, but everyone is going through, millions of people right now going through this frustrating process of, their monthly expenditures going up because of rent and everything.
And I kind of note this a little bit later, but housing's like top priority, really.
Yeah.
You want to stay in your house. You want to live in a nice house, much more than a lot of things that are part of the spending that goes in inflation. Housing's that priority.
Well, and it's a major. It's 30% of make of CPI. It typically makes up 30% of someone's total spend for the year. On average. So that's a big chunk, and it's not like when you fill up your tank, like it hurts because you were putting $50 in, now you're putting 75 or 100 or whatever dollars in for however many times you fill up. But that's like a one-time thing, and it's like, okay, I can squeeze $50.
And you can just not spend that. You can
choose to not drive a little less. I'm gonna drive a little bit less. Or I'm gonna drive not with a lead foot or something. But your rent payment's like, you're paying this for the whole year. Like, this ain't going down in 3 months, and it hurts.
So Edward here, and I do think that to a certain extent, rising rents are going to be the straw that breaks the camel's back for a lot of people, maybe triggering wage growth, or maybe or going into inflation. I do think that it's not the case, though, that rents are this mindless, insensate force of increase and burden upon a struggling population. Landlords and property managers are getting signals, often from sophisticated rent management software that are finely tuned to renters' ability to pay, and I think that they're kind of adjusting rents accordingly. Not all properties and asset types and not all kinds of renters are experiencing the same levels of rent growth. The higher income renters are seeing higher income growth, are seeing higher rent growth than lower income renters. And housing prices, yes, they're a significant and influential part of household budgets and inflation more generally. But as these prices move the economy, they're also moved by the economy. So home prices have cooled off a little bit because people aren't buying homes as much, and rents may not be cooling off the same way as the price of homes are, but they certainly are not rising the same way for every single market in America. Take Phoenix, for example. Incredible rent growth for the past 2 years, and easily one of the top markets in that time. According to the apartment list report we covered last week, for the past 6 months, Phoenix had the lowest rent growth in the United States, only growing by 1% compared to the 5.4% national average. So it's not like this is an example of landlords just saying, or property managers just saying, this is the price, you're going to pay, it doesn't matter. They're listening, and they're not going to leave money on the table because people won't rent. They lower the rent, and then maybe more people come in. So that's my take.
No, I mean, we again going over asset management this morning, and when you see 97% occupied, 98, 99, 98, 99, 97, 98, 99. Mm-hmm. And the lowest is 96. I mean, that indicates quite a bit of demand. And if you only have one unit that's still available at a property, we're not inclined to certainly not lower the rent. The inclination is, okay, well, maybe our rents have been under market, but prices are signals. Markets give signals, prices are just signals. And when we have a lot of signals that there's a lot of demand for this price point, we know that there is demand just above that price point also. Yeah. Because typically we're shooting for more of like 95% with higher rents rather than 100% with slightly lower rents. And again, the market is the market, and whether it's again gasoline or the cost of a rotisserie chicken, or it's natural gas,
Yeah.
whatever it is, it's all the combination of all of these cost increases, and now rent's just on top of it. And so rent is a very emotional part of the economy. Housing is, because as you said, people like where they live, they want to stay. There's a lot of emotion tied into that. Even if you're renting, even if you knew you're not going to be living there forever, it's like, this is my home. And the idea of like, you're going to make me leave my home, that's an incredibly emotional thing, much more than it's going to be more expensive to fill up my car.
Yeah.
Or go out to eat, because there's choices. You can drive less. You can eat more affordably.
Yeah.
And you can live like all those. You can live somewhere more affordably also. Like, I guarantee a lot of people are saying like, I can't afford the rent. There is a place that they could go that they could afford, but they don't want to go down to that option.
Yeah, it's a difficult decision. It's way more difficult than, and I'm gonna repeat myself, way more difficult than like getting an off-brand cereal.
Yeah,
it would
exactly.
be getting a cheaper house.
It's easy for someone to be like, okay,
apartment.
one night out of the week or 3 nights out of the week, we're going to do ramen noodles or beans and rice. We're going to go on a food, but that's something you can really control. Like, right, we're going to spend $100, $200 on food this month. Like, we can make it work. We can plan. There's only so much you can do. Again, with housing, it's we have to make a year-long decision, not what are we going to do a couple nights out of the week?
Yeah.
Or the month.
So ultimately, according to a Bloomberg article, and this is why part of the reason why another Bloomberg model said that rents are expected to increase to 7.2, and they're at 5-point run right now as measured by the CPI. That may still be low, and 7.2 may be low compared to what we're seeing, but still that's an increase as measured from 5.1 to 7.2. That's a big increase. And I think that will start people thinking. Now, I wonder if that 7.2 will still be under like technically measured inflation, whether it's core or not. But that means really, from an investor standpoint, that means that there's room for rent growth. You see the difference between housing rent and CPI, and this is what people were saying in December of last year, that like, well, you know what, as high as you think these housing prices are, there's actually some room for even more housing price increases. So that's the thing that people have got to wrap their heads around, and they're writing all these articles about people that are struggling, and it is a real struggle. But the fact is like, it's not even at a parity with inflation.
And people have been missing that point for the last year or so.
Yeah.
Because we were talking about that all last year, early on this year, of like, no, there's still a lot of room here. When we were looked in, the predictions came in for this year for kind of a sort of a correction in rent growth and not necessarily declines, but kind of like we're totally reverting back to normal by the end of the year. And you and I and some other folks, and when we interviewed Noah Stone, it's like there's nothing really actually pointing to that other than people just saying that like, well, it seems high, so it's got to come down, but not really looking at any of the drivers or the evidence for why it's high and why would it come down.
Yeah.
So eventually, there will be some kind of correction and growth. But again, it comes the whole idea of timing something in the market is like, you can be correct. Like recession, there's going to be a recession, but trying to say when that recession is going to be, or trying to make some call, you're not going to be very successful many times.
Yeah. Just to close it out, and this is less about multifamily than about the economy in general, the author does have one silver lining kind of in his closing paragraphs. He says, I do think that there is fundamentally less room for companies to cut physical capital and human capital investment than in any business cycle I have personally witnessed. Now that does seem a little bit like a recipe for further inflation, but it is, it's a nice news for this kind of maybe jobful recession or employment in general. I think that's the number, one of the big chief factors, whether aside from like population itself, is jobs. And that's connected to rent growth. And so that's what we need to really be following.
Yeah. No, a strong job market, it makes sense that there would be a strong rental market as well. All right. So continuing on to inflation, just, even more talking about multifamily. RealPage, how do rents move in a high inflation environment? Well, let's look back to the 1970s. which, we never thought we'd be in kind of this type of era, although obviously quite a bit is different, but
that picture, I looked it up. That's not actually from the 70s.
Yeah, it's just like it's got like an Instagram filter on a bunch of water towers. But I think that's what they did. They got the old school cool or whatever, the vintage Instagram filter. Anyway, how do rents move in a high inflation environment? Looking back to the 1970s, Jay Parsons, who does a lot of good work over at RealPage, roaring inflation is opening new questions on the outlook for rental housing. A lot of the same topics, a lot of the same questions. But yeah, Matt, so what happened in the 1970s, and is it the same type of thing?
I was taking a look at this. No, we're looking at a chart of rents and U.S. residential rent growth from 1974 to today. And last night, I kind of overlaid that with the CPI numbers for that same period, and they're pretty dang close. The author says from 1974 to 1985, a stretch that included 3 separate economic contractions, rents increased 7% to 12% each year. That's pretty close to where we are today, and perhaps a sign of what's to come with rents if inflation persists. And it's a reason we're skeptical of reversion to mean rent forecasts, even if the economy continues to soften. I've been talking a lot about what might happen if they've been moving up, if rents have been moving up, and how the renter population has responded to increased housing costs. And last week we discussed how lower income renters may be feeling the impact of these rising costs more acutely than higher income renters. About how Class C rents are a little bit slower to grow, but rents are still growing. Even just taking Class C properties isolated from the multifamily market as a whole, Class C is paying 13% more year over year. That's their rent growth, and then that's renters by necessity, and lifestyle renters are growing by 15%. So still really high rent growth. It's just slightly lower than others.
And it's mostly being driven by the kind of the higher end, kind of B through A sector. It seems like, which makes sense because we're also seeing more, collections issues in kind of the C class workforce housing, which you would suspect in an environment where people are getting squeezed pretty tightly from everything else.
And that's what I was wondering too, is like what's the wage growth during this period? And according to the Atlanta Fed wage growth tracker, yearly wage growth for the third and fourth quartiles, so these are the lower income quartiles, is 4.3 and 3.6 respectively. The first
for the current period or from the 70s?
For the current period, I'm sorry. This is just last year's wage growth. And then and then the top quartiles were 6.7 and 5.7. So there's a clear divergence in wage growth depending on income level, and you can see that, I was looking back at the Yardi Matrix report for last year, and then looking at the rent growth for them, and then the Class A, B, and C, the vacancy for Class C properties is much lower than Class A properties, but they just cannot.
They're filling up, but people can only pay so much.
And so there are challenges for investors in this environment, even though so for investors this doesn't seem like that bad of news. Real estate's a hedge against inflation. Multifamily real estate's one of the best hedges against inflation. But the real challenges now is what it says is, of course, this doesn't solve for the rising cost of capital in getting new deals done, but it positions current owners well through an inflationary period. I think that it's going to be interesting for people that are, and going to be a real opportunity for people that can kind of figure out interest rates, because it seems like we have one of the best asset classes for an inflationary period.
And that's what we've been talking about, is that the fundamentals of the real estate make a lot of sense. It's just, how do you transact, and how do you what type of debt do you use? And you're rolling the dice on getting a higher interest rate, assuming at a high interest rate with a low cap rate, requiring growth to kind of get you out of that. And we're seeing the growth there. But again, as we discussed, if that growth ever stops, if we ever hit a recession and we do see incredible demand destruction, if you don't have that seasoning period, you might not be in a good spot. I mean, because like the properties that we bought last year, they've seasoned so much in the last 6 months, what would typically take us 2 years to do, and so they're all in a really good spot. But on these new acquisitions, the current owners and the sellers have an idea of the price should be here, and that you could make sense of that in today's environment if interest rates were down here, but it's all inverted. And so the deals don't pencil, especially if you're looking for cash flow, but for existing assets and, hopefully for buying opportunities with sellers that are kind of come back to reality. It's an incredible environment, but it's just, again, if you had to go through 100 deals to find one, maybe you're having to go through, 200 or 300 now to actually get one that works and a buyer that is comfortable with a price that makes sense for them, but also makes sense for you, for the buyer. It's not easy to do. They're out there, but it's not easy to do.
And you're a seller and you're seeing that the demand is there and you're seeing all these really great fundamentals. It's just hard, it's hard for buyers and sellers. I bet, in some ways it's particularly hard for sellers.
It's tough because it's usually, you'd say, you're a buyer or a seller. You're never, can't choose, hold and neutral. It's like you're either a buyer or a seller. And sure, you can be both, and stuff can be at different cycles in their investment life. But right now it's a tough question because it's like, I want to be a buyer, but it's hard to be. And I really don't want to be a seller right now. Because that's, unless you get a buyer that's just ready to go, I mean, it's going to be tough, especially if you have to sell something right now. It's tough. So multifamily died. 15% of renters are behind on their rental payments. This is something we've talked about. And again, especially in kind of the C-class workforce housing space, Matt, what's going on? People aren't paying their rent. That's what we've seen.
15%. That's according to the Household Pulse survey from the Census Bureau. Now, this to provide a little bit of context, this rent payment rate has been around the same level for months. I looked at the previous Household Pulse report, and it was around 84%. It was around 84% last December. So it's not exactly perfect. It's not exactly a story of an increasing amount of late payments or missed payments. This is really a collection of sources and opinions that highlight the increased challenges of the affordability crisis for lower income renters. Lower income renters, instead of 15% being behind on their payments, 20% are behind on their payments. And then on the other side, for renters making 100 to 150,000, only 3.5% are behind on their payment. I think ultimately increases or decreases in wages could be the determining factor here. This is what I keep kind of coming back to. If there was a theme, I guess inflation would be one of it, but really the connection between wages and housing costs and housing demand, really. I think that this article does a great job in really making that connection. That's to repeat myself. What I'm wondering is, could we be facing a situation where increases in other areas like gas and food put downward pressure on rent growth? I think it might be true to an extent. I think it could be playing a role in reduced rent growth and higher delinquency rate. But I think that like I said before, housing is at the top of the priorities for people. I'd rather pay. This is where I teased it earlier. I'd rather cheap out on my cereal than I would on my house.
Here's the difference: is that the people in the workforce housing and C-class properties, different from Class A luxury, is that they can go around the edges of getting the cheaper cereal or whatever, but they can only absorb so much. And the pushback is so much more, so the on-site management teams are like, look, everyone's pushing back. Where a Class A property, maybe there's no pushback or very little pushback because people are, as we've looked at, are making a lot more money. Maybe this is someone who is going to buy a single family home and they've got, $50,000 in the bank, sitting there ready to go. They're not spending it. And they're like, well, I want a nice place. And so if they're saying, well, your expectations were $1,500 a month, it's actually $1,700 a month. They're like, 15, 17, I can afford it. And so that's not that big of a deal. But $200 to someone who's been paying $800 or $900, now you're paying $1,000 or $1,100.
Yeah, it's a much larger.
It's a larger percentage increase, and also it just affects them that much more. And so it makes a lot of sense. And I think we're going to continue seeing that. as those two pull away.
And that's a good counter. That situation right there is a good counter to these opinions of landlords and property managers as just like turning up the dials on rent growth, not really listening to the experience of renters. I said last week, I think that landlords and property managers and even the software itself is sensitive to the needs and struggles in a way of renters. If they can't pay, there's going to be some feedback that they're going to get, and it makes good business sense to make sure that their apartments are occupied. They're not just going to raise rents and have everyone unhappy.
But again, it's if they're looking at the occupancy, they're 99% occupied.
Yeah.
While the revenue the lease rent optimization or the revenue management software. It's looking at occupancy, it's looking at comps, and that's it. There are no. I mean, that's the one benefit of it is that it removes kind of the emotions of a property manager of being like, well, I've had some conversations, and the feedback I'm getting and feeling is that that people just can't afford these rent increases.
Yeah.
The data may be showing something a little bit different. But like that manager, and the only people who are going to come to talk to her about it or him are people who are having issues and they don't want to pay more, whether they can or they can't. A lot of them, can't, or it is going to be a big issue. But it's a small sample size. Maybe it's like three residents, but like those are the only 3 conversations she's had related to rent increases. The residents that can't afford it aren't coming and talking to the manager, but the lease rent optimization, revenue management. If you're using kind of an automated, system to automatically set your rents, it's just looking at the data coming in and setting at market.
Yeah. And that's why one of the things that I was thinking about, and I wrote here earlier in my notes, is a lot of it may have to, yes, wages are important.
It's also qualifying. You got to be able to qualify for the rent based on your income.
Yeah. And I think household formation, it could be another kind of knock-on effect of the increased rent. So maybe they're not, it's not that they're choosing not to rent, but maybe they're getting roommates and they're paying their rent that way. So maybe 2 people are renting 1 unit, or maybe 3 people are renting 2 units that could have been 3, or something like that, where there's just more people that are filling less units, and that may affect demand and may
I think we're going to definitely see more of that, and I think that we've got room to absorb that, because again, occupancy is all-time high, and so if that occupancy decreases, people moving in together, I think that's going to be fine. We probably will see that, and I think that will also lead to a further increase in demand for, because to your point, 2 and 3 bedroom units, because a lot of people aren't going to want to take the full rent just on their own. And go into a single, especially if the 1 bedroom, the 2 bedroom are relatively close in price. You bring on a roommate, your monthly spend on housing is been decreased significantly, and you go to a 3 bedroom unit, which aren't that many of those around. You may have to pay up for it, but if you can get 2 other roommates, or even just split it with another roommate, I mean that's a lot of savings.
Yeah.
So I think we're definitely going to continue to see that. Probably more of that than people like moving back in like with their parents that we saw the last recession. And I think again, a lot of that comes to demographics of where people are. People don't, they lived with their parents for a couple of years. They don't want to go back. Parents don't want them back.
And I looked at household formation, just kind of percentage change since the year before, and it is a volatile mess a little bit. It's hard to really predict or see a general trend. So good luck to using that as like a predictor of rents, because I couldn't really figure out, what could not be an oracle in that regard.
No. Okay. Are prices of multifamily properties, are they going down? Cap rates might finally start to rise again, according to GlobeSt. Well, you heard it here on the Gray Report about a month ago. The cap rates have already risen.
Yeah.
Cap rates have already risen, depending on your market, depending on the asset, 25 to 50 basis points. That's what we're seeing across the board. But that's after we've seen an incredible amount of cap rates declining or compressing. And just as a reminder, when cap rates go up, prices go down. And when cap rates go down, prices go up. It's that metric that we use to evaluate all types of commercial real estate, as well as multifamily, which is a sub-asset class of commercial Real estate. So they're saying cap rates might finally start rising again. Again, I think that's old news, but finally they were starting to report on it.
Yeah.
Cap rate data it's opaque. It's not accurate. It's incredibly lagging. Also,
yeah, it's often old news. Yeah,
it's old news. It's oftentimes at 6 months, kind of in the past. Because if you think about it, to get to the point of someone's reporting on a cap rate. First off, so we're looking at actual sales, not just offers, but actual sales. So a letter of intent gets issued, or let's even go further back. A owner decides they want to sell a property. They take it to a broker, several brokers. The brokers create what is called a BOV, or a broker opinion of value. It's basically a proposal saying, I want to list your property. I'm going to get it sold. This is what we're going to do. And this is what we think we can sell it for. Okay. So they've got an idea of a price based on their income. Because cap rate is basically you take your net operating income, dividing it by your cap rate equals your value, or you can chop up that formula a couple different ways to provide any of those three variables between cap rate, purchase price, and net operating income. So they've got a cap rate in mind based on current financials at the BOV. Then they take it to market, have conversations, they get LOIs. Okay, so now that's another indication of price in your cap rate. But then it's whatever the price it actually goes under contract for, which may increase or decrease depending on where the market is. But then it takes, so by the time it goes from BOV all the way to actually closing, let's fast forward, that could easily be 4 to 6 months, like easily.
Oh, yeah.
Because just the process of once you go under contract, you have 60 days. It could take 30 to 45 days to market it and do the LOIs. So we could easily be looking at 6 months. But then even to get to the 6 month point, a lot of brokers don't, the information, it's not like it's public information, like this property traded for X cap rate, or even the purchase price is oftentimes disclosed. And so we're relying on self-reporting in most cases. And I know many even brokers will give false information because they don't want people to know what price.
Yeah, there's a lot of people that are interested in keeping that amount obscure.
Yeah, so the cap rate data, especially historical data, it's pretty garbage. And I mean, if you go on like a lot of the data analytic websites, like a CoStar, that show the cap rate, like they're so wrong, it's laughable. They're so unusable. They're like consistently 100, 150 basis points higher than they actually are. You can use cap rate surveys that kind of people give an indication of where cap rates are, and brokers will kind of tell you. You have to use a kind of handful of different data sources, understanding of really what's going on in the market. It's a fluid number. There's not like one cap rate. But what we know is with rising interest rates and cap rates so low, you can't justify the purchase without using a high interest rate loan, relatively high, and a low cap rate. Like it doesn't pencil, and the cap rates have to come up to get the financing to be able to close. And so it's a pretty natural, cost of capital issue. Yeah. Now there's an incredible amount of demand from the renter and the investor side, but that doesn't mean that people are going to accept, very low single digit returns.
Yeah, well, I mean, for the CRE side, the rise in interest rates have cut down a large population of investors and buyers that were able to pay because of leverage. Yep. And now with that smaller pool of investors, that means lower demand. Yep. I don't think that the people that can make it work are able to make every single deal and account for everything that was lost from the investors that weren't unable to make it work. Yeah. So as kind of an overview of each different asset type, multifamily and industrial assets, according to this article, set first quarter price growth, which is great. That's a story. But the office and retail were a drag on CRE price growth. It does note that industrial square footage under construction could slow price growth, but reading between the lines, they say office and retail drag on price growth. They say the industrial asset prices are going to go down. So where's multifamily? Multifamily, the only thing they said about it is that it had record price growth. I think that the increase in interest rates is a market shaping force in and of itself, and so that's going to result in higher cap rates for multifamily properties. But it doesn't have those extraneous forces like an relative increase in supply in industrial, or the kind of sluggish performance of retail and office.
One beneficial part of all this is I think we're getting some really good insight of the conversation of the correlation or causation discussion between interest rates and cap rates. Because for the longest time, there was an assumption of, yeah, well, there's some correlation there. And then it's like, well, maybe not as we thought. But we're now able to really kind of test it across different scenarios and extremes. And what it seems, where the evidence seems to be pointing to is that it's really volatility that has a more of an effect than just what the actual rate is on pricing. Because I think if rates move up or down slowly, it has a very negligible effect, especially within a certain range. But at the rate of change in interest rates, I think does have a much more dramatic, and we're seeing it right now.
Oh, that's very interesting.
The switch has been flipped.
Yeah.
For rates, well, the switch has been flipped for us buying as well. Again, as opposed to that kind of gradual transition, because we saw a gradual transition, back in 2018 or end of 2017 into 2018, as interest rates were rising and rising and rising, but cap rates stayed flat and then actually continued to decline because there was more and more investor interest. The fundamentals were still solid, but it was kind of like a boiling frog situation of interest rates are a little bit higher and returns are a little bit lower, but just slightly. It wasn't enough that you weren't going to do a deal. Because like let's say you were, this was a couple of years ago, you don't see cash on cash numbers like this too often these days, but let's say you were underwriting a typical deal, you could hit 8% cash on cash, or let's say 8.5. Now that the interest rates have risen and now your year one cash on cash is 8.25. Well, are you not going to do the deal because of that? Or at 8%, it's still pretty good cash on cash. Are you not going to do the deal? 7.75%. It still looks like an acceptable deal. It has to really get to a point of dramatically lower. And again, over time, if you are willing to accept a slightly lower return, over a longer period of time, it's all relative to the last deal, whether that's from the buyer or the investor. So the investor's like, well, what did I get in the last deal? Okay, well, I was getting 7% cash on cash year one. Okay, well, that 6.5 doesn't seem that off. But if you go from 8 to 6.5, that's a big shift. And where we've gone from was a couple of years ago where you could get 8% out of the gate because 8% is a common preferred return in private equity, but especially in multifamily and real estate. And so a lot of times an operator, not always, not because you couldn't do this in every market, but like in the Midwest, we could typically get at least 8% cash flow year one, sometimes even more within interest only. Wasn't too long ago, you could underwrite seeing double-digit cash on cash year one. Because if you're using moderate leverage, but then over time it was going from easily able to hit 8. We're really needing to see at least 8%, but then it was kind of 7, and then it was low 7s, then it was 6, and all of a sudden, when cash flow is in year one is like in the 5s, that's when we really started scratching our head of like this doesn't seem like the deal this isn't what we wanted to see. But now you're looking at a higher growth environment. You're getting better cash flow in later years. Cap rates have compressed. Oh, if you throw a low cap rate on there, it still makes sense. Well, now you're really getting into the area of speculation.
Yeah, that's well. In the same way, this is what I'm kind of thinking. In the same way for renters that are reaching this ceiling of rents they can't pay. Is there ever going to be a ceiling? I know cap rates are rising now, but the long-term cap rates, the long-term trends where cap rates keep compressing. Is there ever a situation where like, well, I can't imagine they could go any lower?
I mean, we've been at that point a couple times over the last couple months. I mean, when the first time we were like, oh, that deal sold at a 5 cap. We were like, that's nuts. 5 cap, that's insane. And then all of a sudden, a couple years later, we're like, oh, a 5 cap, that seems like a great deal, like a true 5 cap. And where a year and a half ago, prior, we bought at a 7 cap. And then it's like, oh, it traded at a 4 cap. Then it's like, oh, well, mid 4s is now the norm.
Yeah.
And because the outliers, the 3 cap that sold. Oh, well, there's a 2.5 cap that sold. So, can they go low? I mean, are we at a point where it was insane? Like, yeah, we were at that point. But now we're saying someone could justify it. I don't know about the 2.5 cap purchase, but even that, if it's an incredible piece of real estate and you've got a business plan, because again, the cap rate is just a snapshot of in the past. It's not necessarily a predictor of future return.
If you think it's going to grow, or if you think you're going to sell it for more value. It's almost like these are becoming less cash flow and more about appreciation.
Well, that's how I think it turned over the last couple of years, is people were seeing like, hey, we don't have to hold on to this thing for 5 to 7 years. Hold on to it for, a year and a half, 2 years, and we'll just, crush a mid-20s, or low 30s IRR.
Yeah.
And just keep turning these things, because you were getting so much price appreciation so quickly, which isn't necessarily common historically.
Mm-hmm.
And because not all of it was like forced appreciation. It wasn't a value add. It's not like they fixed it up and they flipped it. It was they bought it and just rents naturally grew and cap rates naturally compressed, and it didn't really matter what they did. In fact, maybe the less they did, the better, because people were looking for more meat on the bone at the end of the day.
Yeah.
So the pricing, was much more speculative about selling it to the next buyer, being the core piece of the business plan of like, we're going to buy it and then we can get some cap rate compression, or we're going to flip it out in 2 or 3 years, versus at least how I got into the business, and kind of still the way I like to look at it is like, let's set up this long-term, cash flow vehicle to hold over time, to throw off cash over the next, 5, 7, 10 years. And there's going to be an incredible amount of price appreciation over time, opportunities to refinance and pull cash out. But it's not how many times can we just flip and move in and out of properties. Yeah, because
it's completely another different way of seeing things, and it's a little scary. It seems a little more risky if you're separating it from the cash flow that's supposed to be the foundation of the investment, and if it's not providing that, then what is it?
Yeah, it's just the thought that someone's going to pay you more for it. Down the road. So
wow,
and that's how I think a lot of the economy has gotten into this situation that we're in. Is that whether it's stocks or crypto or anything.
Yeah.
Someone's going to pay me more at the end of the day, because my buddy down the road just made, 100% in 3 months.
Well, and if you want to generalize it, this may be, the trend of higher cap rates may be following the general trend of away from growth to value stocks. I think that seems like it would make a whole lot of sense in a higher.
Why would I think so? I mean, why would it be any different from anything else?
Yeah.
We're not in a vacuum, maybe uncorrelated from the stock market, but just general economics.
Yep.
It's all intertwined and interconnected.
Yep.
National Association of Home Builders. This is going to be the last piece. But we haven't asked you this, so we wanted to give you some space. We wouldn't want to be too forceful, but if you're enjoying, you've gotten this far in the video, if you could give us a like and make sure you're subscribed to the Gray Capital YouTube channel, Matt and I would appreciate it a lot. What it really does, it helps the show get out to more people. We would like to grow the audience of the Gray Report. Put a lot of time and effort into it. Again, we started doing this because we wanted to be up to speed on everything going on in the housing industry and multifamily. This needs to be great. It could be a great service, not only to our partners and our investors, but just the broader investor community as a whole. So you can help us help the broader investing community by, again, liking this video, making a comment, and subscribing. That'll plug it into the algorithm to send it out to more people. And, hey, if you really like it, share it on your LinkedIn, your Facebook, your MySpace, whatever platform you are using more frequently today. Greatly appreciated. So the National Association of Home Builders, Matt.
Yeah. So
have building material prices peaked?
So for 2020, the year of 2020, I remember tracking building materials, and especially the run up in lumber prices.
Yeah, we were doing technical analysis on lumber.
I remember
didn't make any sense.
Can't believe it. Well, lumber prices are down significantly from those highs. I think that's great for multifamily developers bringing new apartment supply into the market. But it's not like all construction materials needed are as easy to buy. But then again, this report suggests that we could see a lot of these material prices going down due to reduced demand. Steel went up a lot last year, but it hasn't really increased its price too much in 2022. 6 months with like a 3% price increase is really great, considering the increases we saw in 2021. Reduced demand is what they say, again, is driving these, specifically the reduced demand that has followed the increase in mortgage rates for home buyers. At the same time, for individuals, or more relevantly for investors, and I've kind of hinted at this, we we talked about this. For those people that can create a plan to mitigate the difficulties associated with interest rate increases, there could be a real significant opportunity in this changing environment. You talk about, whether you're a buyer or a seller, you want to be a buyer in this environment if you can figure out how to solve the problem of reduced access to capital.
Yeah, 100%.
And once you get over that, and maybe it's creative leverage, maybe it's more just pounding the pavement and finding out more investors. But man, if you can get past that, it's really.
Well, I think the investor, the equity is out there.
Yeah,
it's the debt, and it's a little bit of investor expectations, but it's the debt.
Yeah.
That's what makes it challenging. But there are definitely opportunities out there, and I think there's going to be a lot of opportunities coming up in the near future.
Mm-hmm.
So we're gonna have to stay tuned. You've already subscribed, like the video, and we thank you for that. If you'd like to get these reports and a lot more sent to your email inbox every week, every Thursday morning at 8:30, which we're gonna be dropping here within the next less than 24 hours, graycapitalllc.com/newsletter. Just drop in your email address. We don't need your name. We don't need your phone number. We don't need your mother's maiden name. We just need an email address, and we will send you the Gray Report once a week, occasionally a Sunday update, packed full of these articles and a lot more. I mean, Matt, how many articles and reports are on the average on the report each week?
Very least 20, over 20.
Wow. Yeah,
but they're not all bad. I don't like filler. I'm not going to give you any filler.
No,
it's only the good stuff.
We don't see. It's got to be the good stuff.
Yeah.
No, like window dressing. No, like garnish. It's all just meat, potatoes.
No room for parsley
dessert.
on this plate.
Yeah, no, there's no parsley, but right. All the good stuff. All right. Check out graycapitalllc.com/newsletter. If you are an accredited investor, you can go to gray.fund and learn more about the Gray Fund. It's Gray Capital's multifamily investment fund, buying stabilized multifamily properties across the Midwest. We think it'd be a great opportunity for you. Love to work with you. All right, we'll see you on the next episode of Gray Report.